Hi everyone, Luke Stein here. As we've introduced a broader set of capital budgeting tools like net present value, internal rate of return, and the calculation of a payback period, one thing that all of those tools have in common is the key input to them is an estimate of the cash flows that a project kicks off. So what we're really going to need to do is calculate an incremental cash flow statement for a project that we want to analyze. By incremental, I mean we want to focus only on cash flows that the firm incurs if they do the project, but not if they don't do the project. So we're going to make sure we exclude sunk costs. That's going to be a cash flow statement. It's not going to be a P&L. It's not going to be an income statement. But we do have to think about the income statement associated with the project because one of the cash flows that the firm may have to pay associated with the project has to do with taxes. So even though what we want to build up is a project-specific cash flow statement, we probably have to think about the profit and loss generated by the project in order to calculate the tax bill. And one of the trickiest components of doing that is going to involve thinking about the purchase at the beginning and then sale at the end of the project of capital assets, property, plant, and equipment. Why does that matter? Well, the project purchase or sale of capital equipment is likely to be associated with depreciation charges along the life of the assets and therefore the life of the project. And those depreciation charges are going to cause a deduction from income. They're an expense, although they do not have an associated cash flow. So they're going to be an accrual that lowers the firm's profitability over the course of the project, and that should therefore lower their tax bill. And so we want to take that into account as we think about the project's incremental cash flows. And then typically there may be an asset sale that happens at the end of the project. If property, plant, and equipment gets sold off, that asset sale may generate either a taxable gain or a taxable loss. If there's a taxable gain on the sale of property, plant, and equipment, that thing is going to result in a tax bill. If instead it's sold at a loss relative to book value, that's going to generate a taxable loss. And so that's going to create a tax deduction for the firm. In order to think about whether there's a taxable gain or a taxable loss at the end of the project, we are going to need to know what the book value of those assets are when they get sold. If they're sold for more than their book value, that's a taxable gain, and the firm will have to pay a tax bill. If they're sold for less than their book value, that's going to be a taxable loss, and that's going to lower the firm's overall tax bill. Therefore, we want to credit the project with generating some positive cash flow associated with the tax write-off. So unfortunately, this turns out usually to be the trickiest part and also one of the least fun parts of analyzing project cash flows in order to calculate a capital budget and analyze whether the project's a good idea or not. But the tax savings or tax charges associated with depreciation and taxable sales of capital goods at the end of the life of the project can be substantial and can really have a big impact on whether the project is worth doing or not. So let's get into it. So when we run DCFs, discounted cash flows, whether that's to calculate an NPV or instead to feed those cash flows into an IRR or payback calculation, we need to think about all of the free cash flows associated with the project. And that's, of course, going to include the tax implications of purchase or sale or depreciation of capital goods associated with the project. This video is not going to be focused on the impact of depreciation on the firm's tax bill during the life of those capital goods. It's going to be specifically focused on how to think about what the after-tax cash flows are associated with the sale of an asset. Typically, that's going to be a capital asset, property, plant, or equipment that got purchased at the beginning of the project or early in the project's life and then gets sold or liquidated sometime in the future at the end of the project's lifespan, although we can also see asset sales that happen at the beginning of a project if, for example, part of what the project involves is replacing capital goods that are currently in place. And so while new capital goods might be purchased, there may be old ones that if the project gets done, get liquidated, and we would have to think about what the after-tax cash inflow is of those transactions in a similar way. So suppose assets get liquidated. As I mentioned, probably at the end. Well, what is going to be the cash flow associated with the sale or liquidation of those assets? We want the after-tax inflow. And what's that after-tax inflow going to be? Well, there's a good thing that comes when you sell assets, which is that you collect proceeds on the sale. So we can think about the price at which those assets get sold, and those proceeds are going to show up as a positive cash flow for the firm when they sell the assets. But If there's a taxable gain, which we'll call a capital gain, that capital gain is going to get taxed at some rate associated with the company's tax rate, which we'll call tau. And so we're going to multiply tau, the tax rate, by the amount of the capital gain. That's going to tell us how big the firm's tax bill is. And so we're going to subtract off that tax bill from the proceeds from the sale to get the after-tax inflow. If the assets are sold at a loss relative to book value, that means the capital gain is going to be negative. So in particular, if the proceeds of the sale are less than the book value at the time of the sale, subtracting off the sales book value from proceeds of sale might give a negative number, and that negative number is going to be a taxable loss. The capital gain will be negative, and so when we multiply the tax rate times that capital gain and then put a negative sign in front of it, we'll wind up actually creating additional after-tax cash inflow. So the after-tax cash inflow from the sales could actually be larger than the sales proceeds. So how do we do it? Step one, we've got to figure out what the book value of the asset is. In order to do that, we need to know what the so-called depreciable basis of the asset is. And typically we associate that with the purchase price of the asset, but there may be additional installation costs, substantial freight, or installation that are allowed according to accounting rules to be capitalized. And so we're going to add those things in to figure out what the book value of the asset is at the time of purchase, the amount of book value that is going to be depreciated over the life of the asset, or at least the accounting life of the asset, and that thing is called the asset's depreciable basis. So typically that should be clear from any question that I would ever give you in our class, because really that's about accounting rather than finance, and draws on a bunch of expert knowledge that I frankly don't have. So step one, figure out the depreciable basis on the asset. Having done that, we know the book value of the asset at time zero at the time that it's installed. Step two, we're going to figure out how much depreciation the firm incurs each period, typically a year, over the life of the asset. So we're going to do that by multiplying some kind of depreciation percentage, which will be in a depreciation table that will always be provided, or that you should be able to look up. And if you're operating rather than just a student in a finance class, you should always be able to ask your colleagues on the accounting side or the financial reporting side what the appropriate depreciation schedule is, and that's going to vary by asset. So different assets have different kinds of accounting rules, different lifespans. So you're just going to need to look in a table. Two typical depreciation schedules are either going to be an accelerated depreciation schedule, which under the U.S. tax codes are typically going to be MACRS depreciation schedules, and they're going to apply some percentage each year to the depreciable basis that we calculated in step one. Some assets may get depreciated on straight line depreciation, which just means that if the life of the asset is n years, we're going to depreciate 1 over n each year over the course of the life of the asset. So we figured out depreciation each year. Then we should be able to subtract off the annual depreciation expense from the book value of the asset each year in order to figure out what its book value is at the time of sale. So we're going to start with the depreciable basis that we calculated in step one. We're going to subtract off each year the depreciation expense incurred in that year, and whatever's left over at the time of sale is going to be the book value of the asset then. Using that book value and the sales price, we can calculate the capital gain or the capital loss just by taking the sales price. So that's going to be the sales price minus the book value. If the sales price is above the book value, that's going to be a taxable gain, a capital gain. If the sales price is less than the book value, that's going to be a taxable loss. And then we can compute the after-tax proceed from the asset sale using the formula that was on the previous slide, and just says that we should take the price, which of course is the sales price, and we're going to subtract off tau, the tax rate, times that capital gain that we estimated in step 4, price minus book value, noting that the thing in parentheses might be positive or might be negative. If it's negative, we're going to get a tax rebate. So how does that wind up looking? Let's look at a couple of examples. So suppose that you purchase equipment for $100,000 and it costs $10,000 to have it delivered and installed. So I'm going to pause there and note that you would consult with your accounting or financial reporting colleagues to confirm that $10,000 installation and delivery cost is a capital expense and can be included in the depreciable basis. And then that means that we've answered the first question on the previous slide. The depreciable basis on this asset is going to be the $10,000 installation cost plus the $100,000 purchase price for a total of $110,000. Okay. Now, assume that the company's marginal tax rate is 40%. So we're going to use that in order to solve for the last step of the question. This tax rate down here is going to be the 40% rate provided in the question. And suppose that based on market conditions and past information, what's happened in the past, we think that we're going to be able to sell this equipment for $17,000 3 years from now. So we need to figure out the depreciation expense each year. We need to figure out the remaining book value at the end of 3 years. And suppose that the appropriate depreciation schedule is a 3-year MACRS depreciation schedule. So that's the first part of the question. So let's move over to Excel. We're going to call this case 1, and we've just estimated that this capital purchase has a depreciable basis of 110. What was that 110? It was the 100 to purchase the equipment plus an additional $10,000 worth of installation costs. Fortunately, we have right here a depreciation schedule for MACRS for this asset. So in class, this would always be provided. And if you're a finance rather than an accounting practitioner, you would want to work with people on the relevant teams within your organization to figure out what this kind of schedule looked like for the asset in question. One thing I always recommend checking when you see a depreciation schedule like this is just, select all the numbers in the schedule and make sure that they add up to 100% if indeed that's what you think they should. So the fact that these numbers add up to exactly 100% after 4 years tells us that this asset is being depreciated over 4 calendar years, which, just to keep things confusing, means that we would often call this a 3-year MACRS depreciation schedule because 3 calendar years starting in the middle of year 1 and ending in the middle of year 4 hits 4 calendar years, even though it's actually only 3 actual years. So sorry, that's confusing. I often find it confusing. You may see this described as a 3-year MACRS depreciation schedule. So we've now done our first step of figuring out the depreciable basis. That tells us what the book value of the asset is after year 0 or at year 0. So what's going to happen? Well, in year 1, the firm is going to depreciate 33.33% times that book value. 33.33% times that book value, or $36.663. So that's the amount, $36,660 approximately of depreciation that's going to be incurred in year 1, which means that the total amount of depreciation that has been accumulated over time is going to be equal to that $36.7 thousand since the asset was purchased. And how much is the book value on the asset going to be now? Well, it's going to be the $110,000 that it was initially listed on the books at minus the 36.7 in total accumulated depreciation, or $73.34 thousand left on the firm's books. So what happens in the second year? Well, we can copy this formula down and that will multiply the $110,000 depreciable basis by the fiscal year 2 depreciation schedule. Accumulated depreciation is equal to whatever was depreciation after the end of the previous year, plus whatever gets depreciated this year, or $85.5 thousand. And so what's left is going to be 110, the initial purchase price, plus installation cost or depreciable basis, minus the amount of total accumulated depreciation so far. And assuming that we did right, we should be able to copy those formulas down, and the remaining book value at the end of 4 years turns out to be 0. So now we know that when the thing gets sold at the end of 4 years, so again, the question asks about the asset being sold at the end of 3 years for $17,000. This number right here, given it's sold after 3 years, is going to tell us what the remaining book value on the asset is at the time of sale. So let's highlight that number. So we've got a 40% tax rate on the firm. We learned from the question that they expect to be able to sell the asset for $17,000. So what's the capital gain going to be? Well, if you sell something for $17,000, and according to your accounting books, it's worth $8.2 thousand, that means that you are going to have an $8.8 thousand capital gain, which you're going to have to pay taxes on. And what are those tax consequences going to be? Well, you're going to have to pay 40% taxes on the $8.8 thousand capital gain. You're going to have to pay a $3,500 tax bill. And since you pay that amount, let's make it negative and show that as a negative $3,500 cash flow associated with the sale just from the tax piece. So what's the after-tax cash flow impact? Well, the firm is going to sell this thing for $17,000, and they're going to have to pay $3,500 in taxes. Their after-tax cash flow impact from selling this asset after 3 years is going to be receiving $13.5K. They're going to receive $17K for selling. They're going to pay $3.5K in taxes on a gain of $8.8K. The after-tax cash flow impact is going to be $3,500. And if you wanted to do that in fewer steps rather than breaking things out explicitly, you could just use the formula that was noted on the slide earlier and say that the after-tax cash flow impact is going to be the sales price of $17,000 plus the tax rate of 40% times the capital gain, where the capital gain is going to be the sales price of 17 minus the book value at the time of sale. And what did I screw up? I put in a plus where I should have put in a minus. So we do need to be careful. I get that 13.5. So how could I have told, how was I able to tell immediately that I made a mistake? Well, I just sort of gut checked. I say, hey, they sold this thing for 17. How could they have gotten 20.5? Well, they would have had to get a tax rebate, but they don't deserve a tax rebate if they sell it for more than it's worth. They should be paying a tax bill. So that's how I realized that I needed to fix this and remind myself that I really needed a minus sign in there, which of course is what the formula on the slides suggests. So we've got a couple more examples on the slides. Suppose, for example, that you think you could sell the equipment for $4,000 instead of $17,000. And assuming that we've written our formulas flexibly, we should just be able to plug in a 4 as the selling price. Now what's happened? Well, given that we're selling this thing for less than the remaining book value, we're selling it for 4 when our accounting books say it's worth $8,200. We're now having a negative capital gain or capital loss, which means that the sale of this asset has a positive tax consequence. The firm gets a tax rebate of $1,700 approximately, and the after-tax cash flow impact of selling the asset for 4 is actually to receive even more, to receive $5.7 thousand. Okay, so that gives us an idea how that example might look. If you sell it for less money, you of course receive less in proceeds. So that should always be the case. If they sell for $17,000, they're going to get $13.5. If they sell for $4,000, they're going to get $5.7. The tax consequence just makes the difference between the after-tax impact smaller than the difference in sales prices. There's another set of examples, which is covered in the slides, where instead there's straight line depreciation over 4 years rather than MACRS depreciation. And all that that's going to involve in Excel is just changing the depreciation schedule. So with straight line depreciation, you can plug in the depreciation rates. You can calculate them yourself if you know that the thing is supposed to depreciate over 4 years straight line and figure out how much should be left. And you can see how I did that in a solution spreadsheet, which is posted. But the solution is reviewed here on the slide as well. So as noted, this is often, unfortunately, the most complicated part of doing these capital budget statements. But if you get it right, you should then be able to apply all the cool capital budgeting tools that we know how to use without incident. IRR, NPV, payback period. You just need to get the same set of cash flows calculated for all of them, and that does require you to know what's going on from a tax perspective.